Hello, everyone, and welcome to our October BMA webinar, which is on creating a GAAP compliant lean inventory valuation methodology. That is a handful. First thing I want to do is the technical aspects, and I just need some responses in either the question pane. Can you see me? Can you hear me? Can you see the presentation? For those of you who attended last month's webinar, I went back to the old version of GoToWebinar rather than the new version because I didn't really understand how to do it. Anyway, let's review some of the aspects of this webinar from your viewpoint. There's a copy of the presentation in the handout section of your control panel. You can download it. If by some chance you forget to download it, or if you're watching a recording of this webinar, please send me an email and I'll be glad to send you a copy of the presentation. For certified public accountants, if you would like to receive 1 hour of continuing education credit for this course, there's 3 requirements. You have to answer 3 of the 4 polling questions, which will come up periodically. You must be logged into the event for 50 minutes, and you must attend the live event. And again, if you want that certificate of 1 hour of credit, again, send me an email and I'll get it out to you. All right, so let's review the agenda and learning objectives. One is to understand the complexities of standard costing systems. Second, I'm going to explain what generally accepted accounting principles say about inventory valuation. Then we're going to look at the reasons why lean inventory valuation methods can be used and are still in compliance with generally accepted accounting principles. I'm going to demonstrate a couple methods for you and then give you a roadmap of how you can develop a migration plan to lean inventory valuations. Then we'll have a quick wrap up. If you have questions, please enter them into the question pane. When we're doing the polling questions, I will take a look and see if there are any questions and possibly answer them at that time. A couple things which are not presented as graphics. I will be using the term GAAP. That's generally accepted accounting principles. Now, I realize if you're attending this webinar or watching it outside of the United States, that you may follow something called IFRS, International Financial Reporting Standards. They're pretty much the same. For those of you who are accounting professionals, you probably will think of some of this webinar as a review, especially when we talk about GAAP requirements for inventory valuation. I'm purposely going to go into a little more detail, though, for the non-accounting professionals so they get an understanding of things. So this is a very a technical type topic, and it really is focused on inventory valuation. So first, I want to do a review of standard costing. And again, a lot of this is mainly for non-financial people, but maybe some financial people will learn a little bit from this. So if you think about the current state, and if you're using lean inventory valuation, for standard, I'm sorry, if you're using standard costing for lean inventory valuation purposes, it's a complex system, okay? You have, for example, purchasing or supply chain people have to determine what the standard material costs are. You need detailed bills of material for accuracy, and I would actually put quotes around accuracy. You need detailed routings for all of your products, again, for accuracy. You need detailed, because you have detailed routings, you need detailed production reporting. Standard costing systems basically kick off variances, which is the difference between standard and actual. And there needs to be some level of variance analysis to really review how quote unquote accurate your standards are. And then of course, accounting has to set the labor and overhead rates. So what's going on here is through the standard costing system, it is valuing inventory on the balance sheet and also valuing cost of goods sold, product by product, based on the products that are produced and the products that are sold. Each of those products have a cost. And so those costs just move the numbers between the income statement and the balance sheet. Now, does a standard costing system work in valuation of inventory? Yes, it does, because it's all based on the production reporting. It's all based on what's being shipped. As long as you load in the standards and set all your rates, it works, but it's complex. So what are the components of a standard product cost? And this is just how does the math work in a standard costing system? Well, your material cost is the standard quantities from the bill of material multiplied by the standard cost of each component. Pretty simple. Your labor, it's the standard time to complete each production step multiplied, and that's in the router, multiplied by the standard labor rate of each step. And each production step could possibly have a different labor rate. Overhead, most of the time, is derived from the standard labor cost. How many dollars of standard labor are there in any product or each production step? And you multiply that by the overhead rate of that production step. And much like the labor rates, you can really have as many overhead rates as you want. And all of this is designed to create what I would say is an illusion of accuracy. Okay. And it helps in inventory valuation, but for the most part, all of this detail is more on the analytical side in terms of understanding the profitability of products, understanding the profitability of sales orders, things like that. But you know, that level, the level of complexity makes things very difficult, because in reality, a standard cost is simply an estimate. That's why you have variances. So how does standard costing value inventory? So you have an income statement on the left. You have your a balance sheet just with the inventory accounts on the right. So this idea of absorption, okay, and it's really more than overhead. It can also be the materials. This is where the costs on the income statement are transferred to finished goods based on production. So the idea, you know, you close a work order, and when you close the work order, the numbers are going to move. And because your finished goods needs to have the material cost and also the labor and the overhead costs, which are called production costs. Then what happens when a product is sold, that cost for that one product comes out of finished goods and goes into the cost of goods sold as all its standard. And then you get your standard margin. So this is sort of the cycle. Now, what's also interesting, and if you look on the income statement, you see that there's variances in absorption. And that's just the difference between the standard and the actual. And the reason that the variances are there is because the income statement, the profit before tax, needs to be at actual. You see, you have standard numbers moving around, so you have to bring the P&L back into actual, and that's how the standard costing system values inventory. All right, so let's do attendance check number 1. Hold on, let me get to the poll. And I will launch it. You have about, I'll give you about 30 seconds. All righty. Looks like most people who have wanted to do the poll have done it. I'm not going to share the results. And move back into the presentation. So that's how standard costing works. Okay. Now I want to talk about what does generally accepted accounting principles actually say about inventory valuation. And inventory valuation and cost of goods sold are linked. Okay. A few years ago, I actually did something that was sort of like nerdy, and I actually read the accounting principles on inventory valuation and what it says, and I learned a whole lot. Okay, and so I'm going to summarize this in layman's terms. So inventory needs to be valued at cost, and that is the same for every asset on your balance sheet. It needs to be at cost. So what are the costs? You know, the GAAP says the acquisition costs, which, think about that, the material that you have to buy. There's the production costs associated with that product. And what GAAP says is that it involves many considerations. You know, and the quote that you see at the top, what are the actual expenses incurred to get goods in condition for sale? And the real key there is involves many considerations. And when I was reading the content of this particular accounting principle, you know, when they wrote it, which I forgot exactly how many years ago it was written, they understand that valuation of inventory is a complex topic. Okay, and you're gonna see a little more about why. The other piece is cost of goods sold. Now this gets into what accounting professionals call the matching principle, where when you're reporting an income statement, you want to show the expenses associated with the revenue that you're showing. Okay. And so another objective of accounting for inventories is to get cost of goods sold correct. Now, sounds simple, and the matching principle pretty much sounds simple. Accounting professionals are very familiar with that. But if you read a little further, that the principle says that it is difficult to match the specific costs to the revenue that is recognized. And that's because of the continuous nature of manufacturing production. It's always going on. And what happens? Well, sometimes products are produced and they're not sold in that same period. They might, sit in finished goods for a few weeks, maybe for a month, hopefully not too long. Okay. So there's, you for example, you produce products in October 2023 and you put them in finished goods, but you don't sell them until November 2023. So, absent a standard costing system, how do you determine what the actual costs are for those products that are sold? The other thing that GAAP recognizes is that prices change over time. Material prices change. Your labor costs may change, and production costs change over time. And so that makes identifying the actual costs of the products that are sold, it makes it very, very difficult, especially because you're supposed to match the actual costs to the revenue. So the solution in terms of GAAP is for companies to adopt a consistent cost flow method over time. Next slide, I'm going to explain what a cost flow method is. GAAP also states that companies can't change cost flow methods every year, okay? Because you can, depending on the cost flow method that you use, you could highly influence the profitability. Also, you have to disclose the inventory valuation method that you use in financial statements. And if you want to change methods, that's a change in accounting method, and that also has to be disclosed. And you think about the financial statements and you think about external users who might be trying to evaluate the worthiness of a company to buy stock or invest in, or even bankers loaning money. Think about those people. If they see these inventory numbers moving because methods are changing, it questions, they can't develop any sense of how profitable the company really is. And so again, this is about being comparative over time and being consistent, right? So what are the cost flow methods? And there are 4 of them in GAAP. I think in IFRS there are 3. First is FIFO, which stands for first in, first out. And what that means is that the most recent costs are in ending inventory, and the older costs are in cost of goods sold. LIFO, which stands for last in, first out, is just the opposite. The most recent costs are assigned to cost of goods sold. It also allows for the average cost methodology, in which inventory and cost of goods sold are both valued at the average cost of all goods available for sale. Then there's also something called the specific identification method, where you can really assign the exact costs to each product as it is being built or produced. Now, the reason that the average cost is in a different color is because that is the basis for the lean inventory valuation methodology. And I'm going to go on to explain this after we do the attendance check. Okay, so wrapping this up, GAAP and standard costing. GAAP says inventory must be valued at cost. Now, GAAP never states that standard costing is an inventory valuation methodology. It says LIFO, FIFO, average cost specific identification. And so that is a sort of like a myth, that, oh, we have to use standard costing because it's GAAP. No, that's not true. And it never says it. Standard costing is just a method to approximate actual costs. You set standards and you monitor them closely to try to get them to approximate actual. That's all that standard costing is. And like I said, it sort of pretty much runs itself based on production reporting and products that are shipped. So it's sort of easy to run, it's difficult to maintain. And variances. Variances bring an income statement back to actual. And what's interesting about standard costing is that if you have large variances, that's an indication that the standards are not accurate. Okay, so I am going to open up attendance check number 2. I just took a look, didn't see any questions so far. Alrighty, I'm going to close the poll. Navigate the screen. All right, so there's the sort of the history lesson. Okay, now let's look forward in terms of lean inventory valuation. And like I mentioned, it's required that you use a GAAP compliant method for lean inventory valuation. Otherwise, if you're audited by any kind of outside CPA firm, they're not going to give you a good, clean opinion. Okay, and inventory valuation is very, very important and critical for companies. Okay, and so let's look at the components of lean inventory valuation and the whys. So why can we move to something simpler than standard costing? So the primary reason is that lean reduces inventory over time, and it can be significant. So think about a target of 30 to 60 days, even though that's not a hard target. It's just something to think about, that when you get to 30 or 60 days of inventory, you can probably move to simpler inventory valuation methods. Materiality. Now, this is another term in the accounting profession. And materiality simply means that if a number on the financial statements is misrepresented in some form or fashion, that it will have a significant impact on those financial statements. And it could, make people think certain things. If you have a lot of inventory, it's very important to value it properly. Again, think about those numbers moving from income statements to balance sheets and vice versa. You want your balance sheet to be accurate. So a lot of inventory, especially finished goods, means that you have to state it properly for GAAP purposes, so the readers aren't confused. But if you have less inventory, the financial risk of being inaccurate decreases a whole lot. And methods, You know, there are simpler methods you can use to maintain GAAP compliance rather than standard costing. Now, I personally experienced this as a CFO. It, been a few years when I was CFO at Bullard. We did basically turn off standard costing and created a lean inventory valuation methodology for the labor and the overhead. We kept material in, but it worked. And, at the time when we did this, our finished goods was very insignificant. I mean, we didn't have a finished goods warehouse anymore. Basically, finished goods was what was in the shipping department that was going to be going out the next day. And I've also had opportunities to work with many companies over the years, including a few large public companies and smaller private companies. Every time, I will say, I'm going to say this later on, every time we decided to move to a lean inventory valuation methodology, we brought in their auditors or their outside CPAs to review the method. And every time they agreed. In fact, sometimes they had some good ideas on how to make it a little bit better. But I have never seen an an outside accounting firm say no to simpler methods. That's important to understand. So let's look at the components of valuing inventory, which is, from a traditional viewpoint, it's material, it's labor, it's overhead, okay? So the material value of inventory on the balance sheet is simply the quantity of each product multiplied by the price. Quantity times price, that's it. So think about this. You either, if you're thinking about your company, do you have few raw materials or many raw materials? Okay, because really we're concerned with the raw material cost here, which will eventually get transferred into finished goods. So if you have few parts, in terms of measuring the quantity, you could do a monthly physical. You may not have to track everything, but if you have many parts, it makes a whole lot more sense to track inventory in your ERP system, quantities, okay? And most companies, I'd say, are on the right. I did work with one company one time where they only had one raw material. It made many, many different types of products, and they actually basically just did a monthly physical because it was powders that were brought in and brought in these huge totes that weighed hundreds of pounds, and they turned them into different types of products. So they didn't really worry about tracking all that in ERP. In terms of the cost that you use in valuing material, if you have few parts, you can use the average cost per unit or average cost per day on your value stream income statement. If you're still tracking the quantities in ERP, it's best to let ERP calculate the value and the overall cost. So you have to enter either a standard cost, an average cost, or a last price paid. Most ERP systems allow you to configure this. And so what do I recommend? Last price paid or average cost. Don't worry about the standard cost anymore. And again, this is pretty much a system configuration process. What's important here, sometimes you companies buy commodities and the prices really fluctuate a lot. Okay, so again, you have to decide what you're going to use, but average or last price paid is better than standard because it's going to give you a more accurate view of inventory because you're trying to get just an average cost of all the material. So when you think about labor and overhead, I call them production costs. Okay, and that's one thing when we put lean accounting in place in a company that I try to get companies, the people, to stop thinking about labor and overhead and think about total production costs. And this is, calculating the labor and the overhead rates and reporting the production. This is where the complexity of standard costing really, really comes in. And it's what I consider the golden opportunity to eliminate a lot of work, both in accounting and in operations. So the first thing to do is to determine your actual production costs. You can get that from your value stream income statement. Value stream income statements are at actual for the period. And if you have different value streams, you may have different cost structures. And so that makes it easier to value inventory by value stream rather than one big lump. Then there's what I call the capitalization of production costs. So if you remember in standard costing, it's, you close a work order and that's how the costs are capitalized. In lean inventory valuation, we're not concerned about capitalizing costs product by product. We're concerned with doing it in total. Just what are the total costs for the period that need to be capitalized? And we can pretty much use a journal entry. So this becomes a financial accounting exercise every month. So what are the requirements to be able to do this? One, you set your labor and overhead rates to 0. And that creates a whole lot of, it eliminates a whole lot of complexity in your inventory system and reporting. You have to develop a method to calculate an average cost. And you also need auditor buy-in on the methodology, okay? I can't emphasize enough the benefits of doing this in accounting, because you know what? Accounting never has to set a labor or an overhead rate again. It also, since your labor and overhead rates are 0, you don't create variances. So it simplifies a whole lot of things. And, personally, when I experienced this, it just made life simpler for everybody. So that's the methodology for lean inventory valuation, and it's average cost, okay? So what I want to do is show you some examples of companies, of how companies did this. Now, I'm not disclosing the companies, and we're changing some numbers around, but there's 3 methods that I would like to show. One is, and this is about creating an average, okay? You calculate average production costs based on the days of inventory, and then you capitalize those production costs based on the number of days of finished goods inventory you have. You can also do it by units. Same thing. What are the actual production costs? What are the total units produced? There's your cost per unit. And based on how many finished goods you have, you can value the production costs, which remember used to be the labor and overhead. There's also what I call a historical margin. And so this is a sort of a different method, but I've seen a few companies use it. It's you capitalize production costs to maintain the historical standard margins and then maybe just recalculate annually. So this is about creating consistency in the financial reporting. That's something that auditors really, really like. So here are examples of each. The days of inventory method. So here you have a value stream income statement for a period, the actual labor, the actual machine cost, the actual outside processing facilities and others. Total production cost for the period, $876,550. What you have 20 days in the month. So the production costs per day, never mind, that says per unit, that's a mistake. The production costs per day, $43,828. The next step, what's your ending inventory look like in terms of days of inventory? So you have raw material, 10 days. Work in process, you have 3 days, and on average, that's 50% complete. Finished goods, you have 4 days of inventory. So you simply take the production costs per day and multiply that by the number of days. So you take 3 days of WIP times the 43,828 and multiply that by 50%, and you get 65,741. Then finished goods, you take the 4 days and multiply it by 43,828. You get 175,310. So the ending production cost inventory on the balance sheet needs to be $241,051. So then the next step is to do a journal entry to get to that number. So, the beginning inventory is $296,509. You want the ending production cost inventory to be $241,051. So you simply have to do a journal entry where you're crediting the balance sheet for $55,458, the inventory account, and you're debiting the income statement, like cost of goods sold for $55,458. So you achieve the same goal. You have a GAAP compliant balance sheet and income statement, but it's simpler and easier. The units of inventory method is pretty much the same. So here we have the same production cost of $876,550, and we're calculating a production cost per unit. 22,861 total units have been produced. So the average cost per unit is $38.34. Step 3, how many units do we have in ending inventory? So again, we're just looking at the production costs. So raw material, there's no production costs assigned to raw material, but there's the material cost. Work in process, again, 3,430 units multiplied by 50% times 3834, 65,758. Finished goods, 4,573 units multiplied by 3834. So your ending inventory is $241,098. That's what it needs to be. So again, you simply do the adjusting journal entry. And that's how you do it. Units of inventory, days of inventory. I've seen most companies use the units of inventory method, but a few have used the days. You know, in terms of calculating the days for work in process and finished goods, you have to have a methodology to calculate the days, but the units on hand for WIP and finished goods, that's just in your system. And it's easy to understand how many units you produced in a period. So this is the kind of entry that can be done every month or maybe just quarterly. It depends on the size of your company and who the external users are. I did it monthly. It's just part of the close process, and it's really, really simple to do. We had an Excel spreadsheet, and we just dropped in the numbers. It calculated the journal entry, and that was the support. And what was also interesting about all this is that that spreadsheet became the audit work paper for the auditors, and they just had to test the spreadsheet. They didn't ever have to test, what your labor and overhead rates are and how accurate they are. The historical margin exercise. Again, this may be useful in certain companies that have maybe multiple value streams with very different products flowing through those value streams. So, excuse me, step number one, and this is in standard costing, calculate your labor and overhead as a percentage of material cost. So in this company, they had 4 value streams that you could see had very different labor and overhead contents based on the percentages. And so it was easier to do it this way rather to lump everything into one big average. So we have those percentages, and we're going to use those percentages every month. So for example, in any month, we know what our material value is at actual for each of the value streams. We simply take those percentages, the historical percentages, multiply them by the material cost, and we understand how much we have to capitalize out of each value stream, and it totals 572, 531. And then, like the other methods I've shown you, it's pretty much just the journal entry. Where the beginning balance is 623,744. The balance at the end of the month needs to be 572, 531. So we make a journal entry of 51,213, where we're crediting the balance sheet, debiting the income statement. And that is the historical margin method. All right, so let us do attendance check number 3, and I think there's some questions there, and I'll take a look at the questions while you're doing attendance check number 3. Here we go. All right, I'm going to close the poll. Hold on. Before I go into the process, there were a couple of good questions. Jared asked, roughly how many is many parts or few parts in terms of the material? Dozens, hundreds, or thousands? I would probably say that a few parts would probably be at the highest into the dozens, maybe even less than that. Again, you have to think about how much are you paying for all this raw material? Okay. If it's common raw material and common prices, then you can probably use the few parts method. Most companies that just about every company but one that I said I've worked with on this, we stick to the many parts method, where we just basically keep material in the ERP system because it's easier to track quantities. Because, if you're not going to do a physical count every month and you're not going to use the ERP system, then what people are going to do is they're going to create their own method to try to track material, and that's waste. All right. So Ken had an interesting comment, question. Since COVID, inventory prices have not been stable, and some just-in-time activities don't work with suppliers. And that means that using last cost would mean the balance sheet is always changing. Well, yes, again, these are methods which have been used. Now, in inflation, it's different. Okay, and you have to think about last price paid versus an average cost. Okay, and you have to think about how much the market can influence your raw materials. But it's good question. And then Peter, in terms of the units of inventory method, can that apply to a factory that is shut down during a vacation period? So Peter is in Europe, and sometimes factory, companies basically take like the whole month of August off. And so how would you value? If the units of inventory method could be used, depending on how much production actually goes on. But if a factory is totally shut down, or totally shut down for 3 of the 4 weeks, it may not work that month, work that well for that month, because the units produced are so low. So again, it's really about how much did inventory change or not. So those are all really good questions, and we'll look again towards the end. Okay, so how do you migrate from where you are today to lean inventory valuations? This is a process. This process may take time. It depends on your company, and depends on the size and complexity and other factors. So think about this in 3 basic steps. Oh, I'm going backwards, sorry. Let's assume you have product cost, standard product costing. The first thing you want to do is eliminate it from any measurement and or analytical practices. Replace it with a box score. We don't want to use it, to understand what's the standard margin. We don't want to use the variances to try to understand performance. Okay, because neither of those are really good. That's a whole separate class. We still want to use the standard product costing for inventory valuation for a period of time until inventories come down. Therefore, what you try to do is simplify your standard costing. So most of the accuracy requirements of a standard product cost are related to looking at the profitability of a product, trying to get very, very granular. But what we're trying to do here is we don't need that granularity at the product level. We still just want to use standard costing the value inventory. So you can simplify rate setting, minimize your labor and overhead rates. And you have one labor rate for an entire location. And you have one overhead rate. You would be surprised that the product cost numbers are not going to change that much. But again, you're not concerned about any individual product. You're concerned with the total valuation of inventory. Can you minimize production reporting? Again, we don't need all this accuracy. So can you start back flushing? Can you just report production at certain steps, not every step? And can you stop reporting actual to work orders? Because reporting actual to a work order is just creating a variance. And what the work order does is it really is taking the raw materials and converting it into finished goods and automatically capitalizing the labor and overhead for that particular product. Material costs. Simplify your bills of material and try to move to an average actual cost. Simplifying bills of material means maybe if you've created some level of flow, maybe your subassemblies aren't really in inventory anymore. Maybe they're flowing. So you can eliminate subassembly bills of material. The cost can be an average cost. Okay, we're not concerned with something like purchase price variance. So even through the simplification of standard costing, there's an opportunity to eliminate a great deal of non-value added work in accounting. Again, we're focused on valuation in total, not product by product. So this is something that you can get started early in the lean journey just to eliminate waste and create some capacity. Then the next step is to move to a lean inventory valuation method. Determine how you're going to calculate an average cost methodology, understand what your ERP system allows, and if it's mainly just like flipping a switch in ERP, saying show average cost or show last price paid, you're done. Production cost, you have to determine how to calculate an average for a period. Units of production, days, or historical margin, or something else you can create. Determine how you're going to capitalize costs and the frequency. For example, you're going to do it monthly. I mean, I work with one company where it's a smaller company and we only capitalize at the end of the year. You need to practice different methods to determine what is the best method for you to use and make this a cross-functional effort. If you have, for example, internal auditors, get them involved in this. Okay, so let's do the final attendance check and then we will wrap up. All right, I'm going to close the poll. Okay, let's do just a quick wrap up. One, you're going to get a survey when the webinar ends. Please complete it. It helps me. And even on that survey, there's a question about, future topics of webinars that you would like. I'm really interested in that information from you so I can design the webinars you want to hear. And a reminder, if you want CPE credit, send me an email and I'll get that out to you in a few days. So, practical advice. You have to design a lean inventory valuation method that works for your company. I've given you some examples. Like I said earlier, you may create something different than what we've done. The real key to success is how you capitalize your production costs. You want to do it at some macro level rather than product by product. Material value. For the most part, you'll probably stick with ERP system to track quantity and use actual cost, an average actual cost, or maybe last price paid. And finally, I've mentioned this a few times, also partner with auditors to create a methodology that they can test. And like I said, every time I've done this with a company, I tell them, even if their auditor is not doing a complete audit, maybe they're doing a compilation, maybe they're just preparing a tax return, we bring them in so they can understand what's going on. And like I said, they have some really, really good ideas. All right, so that wraps things up. And just a couple takeaways here. The lean accounting certification courses are available. Okay, there's the link to the website. I've been talking about this in the webinars. You can get all your information on the website. You can register. The lean management accounting is up and running. The lean accounting process improvement, I have one class number 5 to finish up and load, and then that'll be ready probably within 2 weeks. If you have any questions about the program, please feel free to contact me. If you look at the website and you still have questions, and you can see the pricing right there. And don't forget about our upcoming webinars. The November webinar is creating a continuous improvement system for accounting. And then the December webinar is connecting continuous improvement to the bottom line. And as always, don't forget the 2 recent lean accounting books, The Lean CFO and Practicing Lean Accounting. So let me see if we have any more questions. And we don't. So we're almost at the top of the hour. Thanks for attending the webinar. And again, you have any questions about the webinar, contact me. You will be getting a link to the recording sometime later this afternoon. And please feel free to share it. And as always, I hope to see you online at next webinar. All of you, have a good day.